Dear students, good evening again. In the previous lectures, we have discussed about the IAS-2 inventories. The same topic we are continuing. First, we have done some of the transactions for the inventory using the first in, first out, or what we say the FIFO method. Now we will do weighted average method, because as per the International Accounting Standard number 2, two methods are allowed. First one, the first in, first out method is allowed, and the weighted average method is allowed. We have one more method that was used, that is the last in, first out, but now it is not allowed by the International Accounting Standard. So first in, first out we have already done in the previous lecture. So now we are going to discuss the same transactions but with respect to the weighted average method. The same format, we have a opening stock, we have some purchases, some issues are there, again some purchases, some issues are there, and with respect to the inventory card we have the same, like a receipt is there, issues are there, and the balance is there, and again date wise we have to record the transactions. Then in every section we have three columns, first for the number of the units, the second one for the cost, and the third one for the total cost. The same, the number of units are there, the cost per unit is there, and the total cost is there. And again here for the balance, units are there, cost per unit, and the total cost is there. So the same format is there, same, you can say the transactions are there. Only difference is that instead of first in, first out, we are going to discuss the weighted average method. We have three main sections. All the receipts means normally the purchases are recorded here in the first section. Then all the issues are recorded, means any sales or any issue to the production department, so it will be recorded here. And then the balance means after receiving there is a increase in the balance, or after issuing there is a decrease in the balance. So whatsoever balance is available, so it is written in the last section. We have a first transaction that is the same, but we have done already in the first in, first out method. So that is related to the opening stock, means from the previous year the closing stock or the closing inventory was available, and for this year obviously it will be a opening inventory or the opening stock. So they have an opening stock of 30 units, and the price per unit, that the cost per unit is how much? That is $4. So we have to write directly into the balance section. So 30 units are there, one unit is for the $4, so the total amount is $120. So this is what this will be considered as the opening stock. Then the next transaction that we have, they have purchased some more units. How many units they have purchased? They have purchased 50 units, and one unit the cost is how much? That is $5. So we have three sections: purchases, sales, and the balance, or the receipt, issues, and the balance. So we will write in the purchases section. So how many units purchased? We have purchased 50 units. So the cost per unit is 5, so the total amount is 250. Now here what we have to write, if you remember in the first in, first out method, we have written separately that how many units for the $5, how many units for the $4. But here, this is the weighted average method. We have to use the average number of units, and the cost also it will be considered for the average. So first of all, we have to see here that the cost total is 120 for the $30, and the 50 units, the cost is how much? 250. So what we have to do, we have to get the total of the cost. So the total of the cost, how we will calculate it, is 120 plus $250 paid again. So this will be how much? It will be almost 370. So this 370 is the total cost for the number of units. So it will be written here as the total cost, because we have to take the weighted average. So now the next thing we have to consider, we have to see that how many units were there. We have already how many units? 30 units. And how many new units purchased? 50. So 30 plus 50. So 30 will be here plus 50 will be here. It means it will be 80 units. So now we have 80 units here. So instead of writing it separately, because we are using the weighted average method, so what we have to write as a whole, that how many units are there and what is the total cost. And on the basis of this, what we will calculate this 370 divided by 80. The answer will be almost like a 4.625. So this will be what? This will be considered as the weighted average. So this is the main difference of 4.625. So this is the main difference between the first in, first out and the weighted average, that we are not writing it separately here. We are just combining the total cost then divided by the total units to get what? To get the weighted average cost per unit. So this is what? This is the total cost. So this is the total cost and these are the total units. So what we will get? We get the weighted average cost per unit. So it is 4.625. Now the next one is what? They have issued 40 units. So again, we don't have to segregate that this is issued from the $5 lot or it is issued from the $4 lot, because we are combining it, we are taking the average. So simply what we have to do, we have to write here that how many units issued, the 40 units issued, and the cost we have calculated is 4.625. So simply what we have to do, we have to multiply this thing. So the answer will be almost $185. That out of 80 units, 40 units are issued maybe to the production department or maybe issued to the customer. So simply we have to write the number of the units which are issued, and irrespective of the cost what we have already calculating here, the different cost, we have to take the weighted average cost. It is 4.625. So it means we have a 185, that is the cost of the goods sold or issued. Now here, if we have 80 units in the stock, 40 units are issued or they are sold. So how many units left? Obviously 40 units will be there. So 4.625. So again the answer will be $185. So on the 1st of the Jan, so that opening stock was $120. So if we look at the 2nd January, the closing stock was how much? $370. So if we look at the 5th January, now we have a closing stock of $185. Again on the next date, that is on the 10th, they have purchased some of the units. How many units purchased? 60 units purchased at the price or the cost of $6. Obviously the cost is changing, it may be increasing, it may be decreasing, because it is a fluctuating. So what we have a 360. Now again what we have to do, we have to use the same formula here, the total cost and divided by the total units. So the total cost already we have is how much? Is 185. So 185 plus the new cost is how much? 360. So 185 plus 360. So this is what? This is the total cost that we have. Then the number of the units that we have now, 40 units we have already, and then 60 units we have newly purchased. So it will be 40 plus 60. So here the total cost is 545. So the total cost will be 545. How many units? 100 units. So cost is there. So the cost we have calculated. So $545 is the total cost of the units. Units, which units? The already units we have plus the units we have purchased. Now the 60 units. The total units are now 40 plus 60, so the 100 units are there. And the total cost, which was already 185, the new cost is 360, and if we take the average, so the answer will be 5.45. So this will be the new cost of 5.45. The weighted average cost will be 5.45. So now this is the closing stock on the 10th of the January, $545. Again, there is a sale or the issue of how many units? Almost 70 units are sold. Issued how many units? 70 units issued. So the 70 units will be written here. The 70 units is here. 5.45 is there, and the total cost will be almost 382. This is obviously the like a rounded off value. This is 381.5, so we consider it as a 382. So now the last thing that we have to find out how much is the closing stock after this issue or after this sale. If we see here, we have how many units? 100 units. How many units issued? 70 units issued. It means the remaining balance is how much? That is the 30 units available. So the cost what we have is 5.45 cost is there. So it means it will be 163. So 100 unit is there, 70 units are issued, so 30 unit is the balance. The weighted average cost was same, 545, 5.45, 5.45. So the balance from 545 minus 382, we have a balance of almost $163. So this is what, this is the closing stock value at the end of the month or at the end of this transaction. So we have almost like a 5 or 6 transactions. So after all these transactions, at end date, we have a $163, the value of the closing stock. Now here, if we remember, the opening stock is $120, and these are the total purchases is there. So the total purchases we have, the opening stock we have, and the closing stock we have. So if we have the opening stock plus if we have the purchases and minus the closing stock, so I hope all of you remember this is what, this is the cost of goods sold. Or if we talk about for the trading company, this is the cost of goods sold. And if we talk about the company which is not a trading company but they are using the material for the manufacturing purposes, so this will be what? This will be the cost of material used. So this one we can calculate in the first in first out method or the weighted average method. Obviously the answer will be different. Why the answer will be different? The opening stock obviously in both cases is same. The purchases, the total amount will be same. Only difference will be in the closing stock. In the previous one, the closing stock value was $180, but here the closing stock value is $163. If the closing stock value is changing, obviously the cost of goods sold or the cost of material used will automatically change. So here we have opening stock. If we see here, $120 plus the total cost of the purchases. Cost of purchases is $250 plus 360. So these are the two purchases are there, and minus the value of the closing stock. So it is $163. So if we calculate this thing, so from that we can easily calculate that how much is the total cost. So the total cost of the opening stock was how much? $120. So the total purchases value is 250 because we have two purchases, 250 and 360. So these are the two purchases and the value of the closing stock. So from this we can calculate the cost of goods sold if it is a trading organization, but if it is a manufacturing organization, it will be considered as the cost of the material used. So $567. So this is why this is the value of the cost of goods sold or value of the material used. In this, we haven't considered any purchase return or any issue return or the sales return. We have just taken the simple one that the purchases are there, the issues or the sales are there, and the balance is there. Opening balance was already available, the closing balance we have calculated, and if we get the total here, so the total will be considered as what? The total will be considered for the amount that is issued. So we have the opening stock, we have purchases and the closing stock. Very simple thing that we have to see here, that we have to check that either this amount which we have calculated for the cost of goods sold or for the cost of material used, either it is correct or not. If we see here, we have only two sales here, and this is what, this is the cost. And if we total these two things, so the answer will be same. And if answer is same, especially in the weighted average method, it means whatsoever the calculation you have made is correct. So this is the inventory card, the perpetual inventory card, where you are writing every purchase, every sale, or every receipt, every issue, and after every receipt and every issue you are calculating the balance, the closing balance. And again, we have to check the physical inventory, means at the end of the month, the books or this trading account, or what we say, even the inventory card, it is showing us that how many units are physically available, 30 units. Then the business owner has to check that the 30 units are currently available or not. So it should be confirmed. It is in the books, it is in the inventory card, or it is in the cost of goods sold, but actually they have to count the number of units physically also. And so at the end of the month, the owner of the company or the manager of the company or the inventory manager has to count physically number of the units, and if the number of units are 30, it means there is no mistake, means there is no fraud, there is no error. But if the number of units are more than 30, or if the number of units physically are less than 30, it means there is some error, or there is some fraud, or there is some mistake is there. So that's why this unit is mentioned in the inventory card, because every transaction, every sale, every purchase, every receipt, every issue is recorded. So this record should match with the physical inventory, and if it is matching, it means whatsoever you have done throughout the month is correct. So this is the purpose of the inventory card and the perpetual inventory card. And the amount here, as per the cost, the closing stock value is 163. So this amount will be written in this statement of financial position with adjustment, with if there is any net realizable value adjustment is needed. So if there is any difference, so we have to consider it. But this is the cost of the closing stock, which should be mentioned according to the International Accounting Standard number 2, inventories. So this is the overall understanding of the weighted average method. So you have to consider how many receipts are there, how many issues are there, and what is the balance. And after every transaction, after every receipt, every issue, you can calculate the number of the units and the cost of the closing stock. So this is the overall basic concept of the weighted average method. But still, if you have any doubt, if you have any question, you can ask me through the comment section. So I hope there is no confusion up till now. And in the next sections, what we will do, we will record the transactions, the debit and credit from that, how the inventories are purchased, the net realizable values adjustment, there is any reversal in the net realizable value adjustment, so written down value, so whatsoever is the increasing, decreasing in the inventory. So all the transactions will be recorded in the debit and credit form. Thank you very much.